As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back, Reluctant Preppers. We're delighted to have a first-time guest with us tonight. Lynette Zang is the Chief Market Analyst at ITM Trading. She's been with us, we've seen her interviewed on other channels, and we are delighted that she was able to join us here on Reluctant Preppers. She's here with us to talk about a lot of data-driven evidence for concerns of grave impact in the main economy, the financial systems, and how the risk translates down to the individual family and individual. Lynette, thank you so much for joining us for the first time here on Reluctant Preppers.
I'm really excited about it, and again, I like your work very much.
We've noticed you interviewed on a couple of other channels that are cooperative with us, and I was so impressed that I was reaching out to get you on the show at the same time that we made connection, and we're able, just delighted to get you on our schedule. One of the things that was so impressive when I had observed your interview, for example, on the SGT report with Sean Turnbull, was the methodical and thorough and many-faceted way that you examined and frankly exposed great and significant intrinsic risk that's present in many aspects of our financial system and our banking system and our sovereign debt position, and it really pulled the veil back. Again, I just have to say that coming from a public school background, even trying to read the newspaper a lot or watch the news a lot and try to stay informed, that kind of thing, I and most of the people that I know are just horribly unprepared to really understand what's truly going on in the world of finance. We stumble through life trying to follow the best advice we can get from the sources that are out there, and we make these decisions, and then wave after wave of calamity hits, whether it was the dot-com collapse or it was 2008 collapse and all these different things. We've tried as individuals to think, well, what can I do next time to prevent this kind of catastrophic loss to my family? And yet it seems there's just so little that the individual can do to influence these macro factors, and it seems that the system is set up not for the good of the common people, but for the good of some other powers that be. So if you could walk us through your significant research, what you think the major trends and factors are that people need to be aware of that they probably aren't hearing about from the most mainstream sources, but need to be in order to be aware and prepared.
Although there is something that you said that I'd like to comment on. But first of all, my nickname here is Data Gal, because if I make a statement, I can back it up with what most people consider credible. And so that's how I've developed this, and that's what you see, because most people are visual learners. So if I can explain it and show it at the same time, it just kind of makes a whole lot of sense. But one comment that you made that I am hoping that I disagree with is that I think we do have choices because we vote with our purse. And so it's important for the central banks and the governments that we don't understand what we're voting for, and so that we move forward in a manner that supports their goals. And they actually call that perception management. And we're confused because of that, plus the nominal confusion. When they set up the fiat money system, what they knew is that people do not understand inflation. But inflation, as we all know, is a decline in value. So once we went to a purely debt-based system, this is from the Federal Reserve. This is one of my very favorite websites. It's called, so if you Google it and you put in Federal Reserve Fred, you can pull this up. And this is the value of the dollar from the time that we went off the gold standard in 71 until this is pretty current because I was just looking at it yesterday. So there's officially 4 cents left in purchasing power out out of the original dollar from 1913, but even by the time we hit 1971, there was only 27 cents. So this is what we work for, and we're told to save. And if you get a paycheck today and you go out and spend it right away, okay, that's fine. But I want you to think about the fact that wherever it is that you get that dollar, or whenever that dollar is created along this line, it has the most value that it will ever have in its lifetime. And so this is our dollar that we think of, but this has happened to more than 4,800 currencies. And what people don't understand is this is by design. This is planned. And I've got, anybody can call ITM Trading, and I'm happy to send you out the links so you can verify it from the Federal Reserve or from the horse's mouth itself. And here's the bottom line. This is the problem, okay? There's no purchasing power left in the currency. In addition...
Could I hold you on that for 1 second, because it's so illustrative? You mentioned on the left-hand side of the curve there that started in 1971. That wasn't a random date you picked out of the air. Can you remind our viewers why 1971 is such a critical... What was it that changed fundamentally about the dollar in 1971 and about the United States' posture towards the rest of the world?
Okay, there's lots of things. But in the 60s, there was a run. All right, I'm going to back up a little bit further to move forward on this, because it was in 44 that the U.S. dollar became the world reserve currency. And what that really means is that if you are a country or a corporation going outside of your borders to buy anything, lumber, medicine, oil, steel, you had to do it with U.S. dollars. So at the same time that we were handed that huge advantage, they created the International Monetary Fund, or the IMF, to oversee us. So they are above the law. The IMF is completely above the law. And that system was working okay until we started funding the Vietnam War. And we agreed to hold the value of our dollar stable at 35 to 1 ounce of gold. So the rest of the world knew that that wasn't happening. And so in the 60s, there became a run on the dollar where foreign countries were sending the dollar in exchange for our gold. So much so that by the time we got to August of 1971, we actually had less gold in our coffers than we had prior to the confiscation in 33. And so it became very clear that we were losing that status. And so what Nixon did was he then disallowed foreign governments from converting dollars into gold. So in other words, he reneged and defaulted on Bretton Woods. And so that's really the significance of that date, because I know people say, well, he closed the gold window, and that really doesn't sound like that big of a deal, kind of maybe. However, it's a huge deal, because what he actually did by doing that was he handed over full control of inflation to the central banks. And the central banks are technocrats. They're unelected officials. And they now have full control over the value of our money. And so you can see pretty clearly that that's how they have abused that power since then, and we're essentially somewhere near zero.
And the next thing I was going to ask you, I got 2 more questions on this chart. The second one is it not the case that the Federal Reserve, one of their charter or mission statements is to provide a stability of the currency supply, or stability of the value of the currency, and yet you mentioned that by policy, that this value gets driven down every year. So what is the policy that you're referring to, just at a high level?
Oh my God. Okay, this is perception management. You tell me how stable that looks. Is the stability, all the central banks have an inflation target. In this country, and in many of them, but in this country, that's 2%. So what they're saying is they're targeting the loss of value at 2% every year. And as you can see from this, that compounds. So I guess it depends on what you consider stable. I don't consider this stable. I would consider a straight line or somewhere near a flat line as being stable.
Exactly.
So I think it's garbage.
Yeah, and from my engineering and scientific background, that kind of a exponential decay, like a half-life, you can use, or in financial terms, use the rule of 72. So if you're going to hold your change at 2% per year and keep that relatively constant, then by the rule of 72 divided by 2 means every 36 years, your money's cut in half and cut in half and cut in half, and it keeps getting smaller. And that leads to my third question, and that is when people say, oh, but I'm doing so well because my 401k and the stock market and the Dow Jones is hitting records, you're saying that the measuring stick keeps shrinking. So we used to be measuring in feet, now we're measuring in inches, now we're measuring in centimeters, and on down we go. So of course the nominal, you used the word nominal earlier, but I think that went by very quickly. Can you describe what you mean by nominal terms?
I definitely can. Okay, nominally, and actually if you bear with me, I wish Megan was here because I don't see that she did that. Okay, sorry about this. I'll have to just do it verbally. Okay. So here's nominal confusion. Let's say 20 years ago you had a $20 bill, and today you have a $20 bill. Nominally, they are identical. They're both $20 bills. But what that $20 bill could buy you 20 years ago and what it could buy you today, so its value is vastly different. So that's what I mean by nominal and that's actually what I mean by nominal confusion. You look at that $20 bill and emotionally you think it's the same when in reality this is what it's doing.
So what does that have to do with the record stock market levels that are being hit today?
Everything, because what people look at is they open up their statements and they go, oh, look, my mutual funds are doing so great. Everything must be fine because that's what we've been trained to think. But 1 trillion times zero is zero. So the stock market, as we've seen in Venezuela, as we've seen in Germany, as we've seen, there's so many cases in history where you can see the stock market rise exponentially, and that's where I think we are right now. We're in that last upward draft of it. But if this is worth zero, if this will not buy you anything, then it doesn't matter. It's not relevant how high that stock market goes. 1 trillion times zero is still zero. Some people
that may not be big stock owners might even say, well, at least my home value is going up. I see that the price of my home on Zillow is going up every year. Same problem?
It's the same problem. And not only that, the reason why governments love inflation is because it enables an invisible tax on your work and your wealth. So in reality, the function of a house is to, generally speaking, is to have shelter over your head, provide that shelter. Well, that shelter has a value. I mean, when back in history have houses risen in nominal value at this speed, where people are thinking about it, think about back to 2007 and 8, the house would go up in nominal value and they were pulling that equity out and spending it on vacations, on doing this, on doing that. But you still always have to have a place to live. So what it does is it creates confusion. And in the case of 2007 and 8, it inspired people to spend that equity. And then, of course, the market crashed because it's severely overvalued. I mean, historically, you can go back and look at, well, what's the value in this long term? And in the case of real estate, you should be able to generate roughly 10% a year worth of income on that real estate. Well, as the prices go up, and so people see that and go, isn't this great? Well, you have to replace that. Let's say you sell that house. Truthfully, it's worth about this, but it's inflated to be about that. you're going to pay taxes unless you convert it into another piece of real estate right now. You're going to pay taxes on that inflation. So it's a tax on top of a tax. Did I explain that okay? Did that make sense?
Sure. And if you could now carry us forward onto how that, you mentioned that with the currency unpegged from the real asset of gold, there was this transfer of power into these unelected bankers' hands and into these other, the IMF and so on. So what, if we take this now, I asked you to bring it down to the individual household level. If you could bring it back up to the big macro level again and tell us what is going on and the big picture with these debts that are being used to fuel the expansion of the money supply at that level.
Right. Well, I mean, the system from 71, and maybe I should go back just to make sure that people understand what gold really is and what its true function is. Because I can give you very few guarantees, but I can give you this one. At some point, every asset and every instrument goes to its true fundamental value. And that value is based upon the single most important function that asset or instrument performs for its creators or developers. So with gold, what they needed was a way to value labor and then store it for future use. And the goal was to have that money or that labor have the same level of value. So over the years, they tried a lot of different things, but only gold meets every criteria or most of the criteria to be a good money. Plus, it is labor-based. It takes labor and effort to pull gold out of the ground. So that was actually a very fair way to value labor for labor. Now, on a gold standard, though, governments like to borrow and spend. And so on a gold standard, we would know it if they were taxing us to spend more. And they didn't want our pushback. And so in 1913, they converted us to a fiat money standard. Now, the literal translation of fiat is by decree, but the bottom line is this is government-backed money, and its most important function is this inflation. This inflation, because it's about, we went to a full debt-based system, but they knew that people don't understand inflation, and they also know that people marry the legal money of the state. So in 1910, we had a dollar. In 1914, we had a dollar, but it was a completely different dollar because the one in 1910, a 20th of an ounce of gold backed a $1 bill. In 1914, a 20th of an ounce of gold backed $2.40. So that started the run. But in 1971, we went to a pure debt system. So from there forward, because what do banks know? They know debt and they know leverage. So in this system, money is created from debt. And this is, I just pulled this recently, but this is the key global central bank balance sheets. This is the crisis. You can see that here. And just in 2017, when they're saying how great everything is going and how they're going to take the wheels off their QE programs and all those kinds of things, tell me why they needed to add $2 trillion just through August of this year. It's garbage. The system is based upon never-ending compounding debt. And when they create those debts, that's how money is created in this system. New dollars, new euros, new yen, whatever. That's how it's created. And whoever creates them first, like we saw in here, okay? Well, the central banks create the dollars. And then they go into the banking system before they even go to our government. Our government, we're taxpayers are responsible for that debt, but our government has to buy the dollars from prime banks. It's not a direct transfer because, hey, we're paying the interest on it. So the banks get it first when it has the most value, then and corporations and then governments, and then you and I are somewhere down this food chain. But when they get those dollars, what do? They put them into the stock market, the bond market, the real estate market to keep everything floating up so that you don't realize this is the real trend and this is really what's happening. But unless those things go up faster than the dollar goes down, you're still behind the 8 ball. And at this juncture, it was already at 97, and I was looking at that graph earlier, but I'm sorry, I don't know where it is at the moment. But the level of debt that the banks have created, it was already in 97 when it no longer was economically stimulated. And what I mean by that, that's the monetary velocity. And what I mean by that is if you or I, let's say we just get out of college and we're living at home with our parents, so we don't have any bills, and we get our first job, okay, that means that everything we get is disposable income. And we decide that we want a car, but we don't want to save up for the whole car, so we save up just the down payment on the car, and then we go out, we take out a loan, we take on debt to fund the rest of the car. Well, okay, that means that that debt stimulated my economy today. I'm going to pay it back tomorrow, but today it stimulated my economy. And the banks see that I'm making good payments and they go, wait, how about a credit card? And you go, well, sure, I'd like a credit card. And you get some of those. In the middle of the week, your friends call up and say, hey, let's go out for dinner. And you say, I already spent all my money. I don't have any money. I can't go to, I have credit cards. So taking on your debt, that debt today did indeed stimulate it. You wouldn't have been able to go to dinner without that debt, and you'll pay it back tomorrow. And then the bank says, boy, you're doing good with this debt. You're doing good with that debt. How about more debt? How about a mortgage? And you say, well, I'm really tired of living with my parents. So, okay, I'll go ahead and take on a mortgage. Well, all right. That again stimulated your economy today. But if your income does not keep pace with all of those new debts, at some point, all of your income or most of your income now goes to servicing the debts that you've already accumulated, which means that how are you going to stimulate your current economy? You see what I'm saying?
Yeah, I was just chuckling to myself because you started the whole scenario with you've just graduated from college and moved in with your parents. The reason you moved in with your parents is because of all the student loan debt you didn't tell us about in the beginning.
Well, that's true. But then I wouldn't have been able to get the loan on the car. This was back in the old days when it was $2,500, for a semester at college. At least that's what it was when I went. And I was going to a private college.
Yeah.
Pardon?
That even underscores the principle further, though, is that we've become a culture that is basically addicted to debt. Debt is the facilitating vehicle that enables basically all the wheels to keep turning. Yeah.
That's exactly right. That's exactly right. And so according to the Federal Reserve, the level of economic stimulation, the monetary velocity is worse than it was during the Depression in 33, because most of we run constant budget deficits. That's been true since, 71, once we made that shift, other than a few years when they changed the accounting rules during Clinton, but also in 97 with them realizing that we'd hit peak debt. That's when the derivatives came in, so the speculative derivatives. I should say derivatives have been around for a long time, but the speculative derivatives came on, and that was a function of being able now to even leverage that debt even more. So, and you saw what happened in 2007, 2008. That was a derivative implosion, and a derivative is just a big bet that's based upon the underlying stocks, bonds, real estate, or other derivative bets. So it's leverage upon leverage upon leverage upon. It's way worse than this because this is leveraged. Who knows? Who knows how many times? In some mutual funds, they admit to leveraging 1,000%. 1,000% leverage.
And horizontally, how broad is the scope of this? It's not just the United States, right? We've had other guests on talking about all sovereign nations, not only on the fiat systems, but is this? It seems strange in a situation. Normally, you think simplistically, and I know for some of our viewers, this is like pretty elementary, but I'm sure there's plenty of newbies here that would appreciate this. Is normally when you first think about lending and borrowing, you think, okay, one person's a borrower, the other party's a lender, and there's this exchange, and then there's this promise to pay back. But how in the world is it that all the nations on earth could be borrowers? Everybody's a debtor. Who's holding the other side of that transaction?
Well, you and me. It's the public that's holding the other side because we're the ones that are obligated to repay all of that debt.
So in that sense, you're saying that we have become without our informed consent, or certainly without our informed consent, parties to this debt, right? We're like co-signers on this debt. What the drunken students out there taking on student loans, and it happens to be our government. But who's holding the? To whom are we all beholden? To whom are all the countries of the world owing this money?
Banks, central banks.
And these same central banks that were grabbing the gold until Nixon told them they couldn't have any more in 1971.
Well, it wasn't so. It was the countries. I mean, when up until 1933, individual public could convert dollars into gold. When they made that transition in 2013, they didn't want anybody to know that anything had changed, so they allowed the convertibility. You and I could still convert our dollars into gold, but even as importantly, they allowed the barterability ratio to remain the same. So as they were really hyperinflating the currency in the system, the average income more than tripled. So at that point, the average, there was about a 50% loss in purchasing power on the dollar. But, if your costs double, but your income triples, well, do you really care that your cost doubled? No. So that's what generated the Roaring 20s. And what do we know about the Roaring 20s? A roaring stock market, a roaring bond market, a roaring real estate market. Sound familiar? Lots of debt, lots of leverage. Then when they pulled the punch bowl away, and it was 28 when most of the insiders got out, those that knew what was going on, and they sold into the unsuspecting public, and then they pulled the margin, that credit, whatever you want to call it, the credit away from the public, and then we had the 1929 crash. They used that crisis to justify taking the gold away from the public, but the countries could still make that conversion. Well, that ended in 1971, and that's so, I mean, you can draw your own conclusions, but so much of this, especially since I read the underlying documents when they set things up, this was planned. This is a planned event. Even going to zero on the purchasing power, they know this. That we've got over 4,900 currencies that have gone through this same thing. So wasn't it Einstein that said doing the same thing over and over again and expecting different results is insanity? Well, they may be many things, but I don't think they're insane. I think they know exactly what they're doing.
It sounds very shrewd, and the ordinary person has no idea that they're being set up. And I think it's Greg Manarino has talked to us about the greatest wealth transfer in the history of mankind. I think even
absolutely.
I think Gold Silver talks about that as well. But it's that if that's where Gregory Manarino talks about bet against the central banks, become your own central bank, bet against the debt, do what they do instead of doing what they want you to do. So
exactly. I agree with them 100%. And so I always like to look at what the smartest guys in the room on any given topic are doing for themselves. And then if I can emulate that in some way, that's what I do. Period. End of discussion. Even if it costs me a little bit more, I would always rather be on that in that stable because I'm more likely to come out ahead. And central banks are buying gold like crazy. And 1%ers are also buying gold like crazy, but they're also buying the collectible coins, the rarities. And you can see that in the PCGS ultra rarities chart. And those coins start in the hundreds of thousands and millions of dollars for 1 ounce of gold. And unfortunately, this is not as organized as I would like it to be. I'm so sorry.
That's all right. I interrupted you in your last chart. What was it you were going to show us about leveraged?
Well, this is, I just pulled this the other day from the Office of the Comptroller of the Currency. These are speculative derivatives in the FDIC insured banking system. This down here, now I did not put this box in. So the OCC, Office of the Comptroller of the Currency, and they used to not have that in there. They just started doing that a couple of reports ago, but they report on derivatives in the system. This is where the derivative bets were that imploded the real estate market, right down here. So this is all legacy derivatives. These are all, well, coming up to 2008, these are all speculative derivatives which cannot settle because there's no market for them. They're either these are mostly over the counter, which means they're either bilateral between two parties or trilateral between three parties. So what do you think is going to happen we know what happened when this one imploded. What do you think is going to happen when this one implodes?
So the box you're pointing to, it's a little bit hard to see that far from the screen, but it looks like it's actually pointing, if you could lift that up a little higher, it's pointing down to a low trace that's near the bottom. Yep, down near the bottom, near the zero line, there's a low trace, the foothills of that big mountain, and you're saying there was that little low trace down there. That
a little teeny blip.
And that's what caused the 2008
what created
collapse.
The crisis.
Okay.
What do you think this is going to do?
Well, it looks like it's an order of magnitude greater, and I imagine an order of magnitude greater calamity at least would come out of it. I mean, people who have been listening to our channels know that my wife and I had, after getting burnt in the .com bubble collapse, decided we weren't going to get burnt that bad again. So once our 401k started looking pretty decent again, reinflated, we shifted it off into what was considered a money market equivalent. It was called the reserve fund. And when the 2008 collapse happened, turns out the reserve fund got frozen because they were investing on the backside in Lehman Brothers, and Lehman Brothers went under. So our funds were locked up and tied up, and eventually we got back portions, but never all of it. So we've personally gotten ourselves scorched on that bottom curve on your chart there, and a lot of people lost their homes during that period as well.
Exactly. That's the wealth transfer mechanism. Maybe you didn't have very much, but you bought a house with the variable rates or what have you, and you put your heart and soul and whatever you had into it, and then that transferred away from you. And the other thing I'd like to point out, if you can see this in here, and if you'd like, we'll send you links to whatever
Sure.
it is that I show you today, and that way people can go in and look at them more firmly. But these are the banks. I had just done a report, right? Citibank, Chase, and Goldman, their assets to derivative levels. And Goldman Sachs, which is the third one down, for every $1 in assets, they have $239 in bets against them, but that too is reported in notional and or nominal terms. So the reality is that, and they admit it, the IMF, the FDIC, everybody admits, the BIS, everybody admits that nobody really knows the true value at risk, the VAR, VAR. So these are the bets. And I had recently done a report, remember the bank stress test that came out in June. and they were showing the leverage ratios. And Morgan Stanley had a leverage ratio, I could be off a little bit, but I'll be pretty close, of 3.58%, which means, so that doesn't sound so bad actually, except what it really means is that if their assets drop 3.58%, they are insolvent. They're out of business. And the whole system is incestuously intertwined. So if Morgan Stanley were to go out, that's pretty much where Deutsche Bank is, and the IMF declares them the systemically most important bank on the planet because they're a universal global bank, which means that they are connected to every single financial institution on some level. So it doesn't matter where your wealth is, and it doesn't matter how risky or not risky their investments are. They're as risky as Deutsche Banks are, or as Morgan Stanley's are.
Yeah, so it sounds like it's like the chain, the weakest link in the chain is what you're saying, is that these large, quote unquote, too big to fail banks, if any one of them, whichever one is the weakest, whichever one some kind of event might trigger to have that kind of a negative, go against them, it could pull the whole thing down.
Well, it would pull the whole thing down. And it's not if something goes against them. How do they hold their wealth? They have stocks, they have bonds, they have real estate, they have derivatives. These markets must stay floating because they cannot afford a 4% drop in value, which is why we haven't seen a normal correction in these markets. These markets haven't even dropped 4%. They haven't actually even dropped 3% in quite some time because of this, because of all of that leverage. And it's really the derivatives.
So for people who were brought up with a different value system to think you should live within your means, you should, not stick your neck out beyond where you can afford to. You should be able to sleep at night, that kind of thing. For people who want to reduce risk to their family and not be part of a negative side of a huge wealth transfer again, to not be wiped out by the first time this whole bubble that you're describing deflates, then what are options that people have for taking care of their family, for taking care of their own personal financial risk?
Well, that's why I felt so connected with what you're doing, because I would definitely consider myself also a reluctant prepper. But the mantra is food, water, energy, security, barterability, wealth preservation, and community. And the barterability, any talent that you have or anything that's physical is absolutely barterable, but silver is universally barterable. And so is gold. Gold is universally barterable, but silver for day-to-day kinds of things.
Sure.
So you want to focus in those areas and see where you're most vulnerable and try and fill those in. And on the barterability and the wealth preservation, that's what we do here at ITM Trading. Having studied currencies and currency life cycles since 1987, I see a pattern. I mean, it's a pretty clear pattern once you know what you're looking at. But I do consider myself an artist, and I see patterns. And so we developed a strategy. I developed a strategy based upon those repeatable patterns and valuations. So you want to be prepared to withstand this, but you also want to be prepared, if you can, to take advantage of it. Because wealth never disappears, it merely shifts location. So as you pointed out, in 2008, a lot of people lost their homes.
Right.
Okay, well, if you have your wealth intact, as those prices plunge, and I've done studies on what happens to all asset classes during these transitions, so I can't tell you how deeply it's going to plunge, but I can tell you what it has done historically. Then if you hold your wealth intact with gold over here, then you can convert it into those income producing assets during the reset period. And understand too, we're already in a reset period. The inflation piece, this is a reset. It's just slower. What we're talking about is a rapid reset. When these markets do correct down 4%, you are going to see that you're not going to be likely to get your wealth out of the markets. These markets are not liquid. And that's according to the Treasury Department. And they've been talking about that since 2013. There are no buyers on the other side of these markets. So it's okay if there's just a few people selling, but boy, they have to keep you in. They cannot afford a big correction because if a lot of people try to rush to the door, they're not going to get out.
Well, speaking of people rushing to the door, what about the baby boomer generations going into their retirement years and pulling out their 401k money out of the stock market?
Well, they've had, all of the retirement plans are severely undervalued, whether or underfunded, I should say, whether they're state or they're federal, or even in many cases, the private retirement plans. And unions are in huge doo-doo. The Teamsters ran out of money on March 1st of this year, ran out of money. So we're a generation, because I'm definitely, I'm a baby boomer. And I remember when I was 17 saying to myself, Social Security is not going to be there when I'm ready to take it. And here we are. I must have heard somebody talking about it. What would a 17-year-old girl think about Social Security? Why would you even think about it? But I remember saying that to myself. And I definitely didn't know what I know now. So we're in deep trouble. And I think what we're going to see happen, because we've seen it in Poland, we've seen it in Russia, we've seen it happen in other places recently, where I think we may see a nationalization of the private retirement plans. And, our government has been looking at that and talking about it for quite some time. They've talked about what they call a one-off, where they would just go into those 401ks and the IRAs and take the number that they used was 11.6%. And they would say, a one-off event means that you and I think that they're only going to do it this one time and they're not going to warn you about it. So they'll just do it. And as long as you think that that's it, they're not going to do it again, you won't change your behavior. They actually said that. But I think we could see the private retirement plans nationalized or partially nationalized. You talked about the money market funds. Well, the money market funds were a huge way that corporations would fund their day-to-day activities. And once the money market fund that you referred to broke the buck, they changed all of the laws. And so now they have to have a free-floating NAV, and they put in fees and gates. And that's because if you want to get out, they want it to be really painful so you don't get out. But the government money market funds does not have those same requirements. And so they redirected the money that was normally funding day-to-day corporate activity. They redirected it into government activity, which is actually called financial repression. And they actually talk about that as a good tool too. So, there are so many things to it. It's no wonder people don't understand this.
Yeah, it's quite bewildering. But so if people want to find out how you can help them, how do they get a hold of you, and what kind of services would you provide them?
Well, we are a physical precious metals house, and so we deal in any kind of physical precious metals, but we focus really on silver and on gold. And we do bullion as well as collectibles. So it just depends on what's right for you. And everybody here uses the strategy. So it's a really personalized strategy. Even though we're all basically doing the same thing, my circumstances are going to be a bit different than your circumstances. And so it's a very consultative approach when you call us, that we make sure that we set you up within what is appropriate for you based upon your goals and your budgets. And our minimum is $500 because we feel so strongly that everybody needs to get protected. So, and they can just call us at 888-696-4653. They can go to our website, itmtrading.com. We provide a lot of education on our YouTube channel, YouTube ITM Trading, but we're super keen on education. So hopefully all of these things that seemed a little disjointed today, you'll find on our site and our archives and on our YouTube channel, and they'll explain it more. And everybody has access to all the visuals and all the supporting links for what I say when I say it as well.
And we've been speaking with Lynette Zang. She's the Chief Market Analyst at ITM Trading. And we'll definitely have to have you back on again, Lynette, because even in the before talk, you mentioned that you're an urban farmer, and that's another passion of some of our guests, including Joel Salatin from Polyface Farms and others. So we'd love to have you back on and talk about some more aspects of that preparedness continuum that you described. Thank you so much for joining us for this first time on Reluctant Preppers.
Oh, it's my pleasure. And actually, I became an urban farmer because of all of this.
A prudent action, yeah. Okay.
I believe my research. I know what I put into it.
You're walking your talk.
So that's exactly why I did it, yes.
Excellent. Well, thank you, Lynette. It's been a pleasure meeting you, and we'll have to visit with you again soon.
I look forward to it, Dunagun. You take care now.
Thank you.
Be safe. Bye-bye.
Bye-bye.